Hello, ladies and gentlemen. Welcome back to my YouTube channel. If this is your first time here, please like, share, and subscribe. We share educational content here regarding trading in the financial markets in general. So recently, we have had the market take a very, very deep dive. The crypto market has dived. The stock market is diving. Even the forex market, a lot of currencies are all diving down against the dollar. The question is, where are all of these things coming from? Why did the market tank? And why have we had an abnormal situation in the market since July 2nd? And why I'm pointing to July 2nd as where all of this started, I'm going to quickly show you that. Now, in the market, there are certain situations that are extremely profitable. So we have situations where you have five currencies, major currencies that are tied to the dollar. You have Australian dollar, US dollar, euro, the pound, all of these things. Now, a lot of times when the euro moves, the pound is going to follow. Let's say, for instance, the euro has moved up to the upside against the dollar and the pound is yet to move, or Aussie is yet to move, or the New Zealand dollar is yet to move. Eventually the rest of them are going to move up in that same direction, meaning they have a positive correlation with each other. So they are going to move up in that same direction. But then on July 2nd, something abnormal happened in the market, or at least it's not a very regular situation. It happened in the markets. Now, if we quickly look at NZD USD, that is the New Zealand dollar, we had a situation where, of course, there was an opening gap that the market did not close. So more of the abnormalities as well. Of course, the market, whenever we have an opening gap, especially on the weekly time frame, any time frame at all, the market always aims to close those gaps before proceeding in any given direction, on whichever side it wants to go. On July 2nd, we had the Kiwi, which is NZD USD. Look at this. It took off and didn't print any high, didn't take out any high, nothing of sort, right? But here, looking at using the same logic, we had on the same July 2nd, we had NZD took off, didn't take out anything, but can you see how the Australian dollar took off and went on to at least run through all of these highs before running into this buy side liquidity before falling short, right? Before the sell-off came in. But guess what? At least it took out this high. It did take something out in the market. But then what happened? The Aussie traveled, just took this one out, didn't travel all the way here. Then we head over to the euro. I need you to understand, just stay with me on this. We head over to the euro. Same July 2nd, the euro runs and makes all of these aggressive moves starting July 2nd. We have an aggression to the upside. We head over to the pound. Similar situation. This is July 2nd move. From July 2nd, we take off, and this is what we follow through. But guess what? When we look at the Kiwi, we did not have all those up moves. But I want you to now pay attention to the grandmaster of them all. So now, as a trader, one strategy that I've always done and that I've always used over the years is that I've always exploited lags in the market following up. So for instance, this is a strategy that I've used for such a long time, and you will not even believe how profitable this is. So let us say we have Aussie, Euro, Pound, and Kiwi, five of them. There's four of them that I just mentioned. And then maybe Aussie, Euro, and Pound have moved in one direction and the Kiwi is yet to move. And I go into the Kiwi and I take a position in the same direction that the rest had moved. Eventually the Kiwi moves, or in whichever order, one of them moves, one of them is lagging behind and the rest have moved. Eventually that one catches up, and that's always where a lot of money is made. Trust me, this is a system that I've traded. But guess what? That didn't happen this time around. And the market went on, of course, because of how profitable it had been this time around, I was in with a lot higher risk and, of course, took a bigger loss as well. So this is the market taking off in this type of situation. And this is where we had a completely different situation. So the market tanked. And when the market took this low, when the market traveled all the way to this side, personally, I was not really interested in, taking the buys here, primarily because I did not like the fact that this low was not taken. So I was not in on the buys. But one thing I was anticipating was that I at least anticipated a 50% run. If you go from here to here, maybe if you go from this high to this low, let's just use the recent one. It did hit 50%. But personally, I always like to see the 618 because I come from the ICT school of thought. I'll always like to see the 618. But guess what? We hit the 50% equilibrium, and then that's where the market decided to come back down and run all these lows. But then this long week left behind here. This long week left behind will just tell you that, I mean, it's just the market doing the market's thing. And guess what? I want you to take a look at what the DXY was doing all of those times. All of those times, you could see the DXY tanking and heading to the downside. Guess who was not tanking, who was not going up? This is supposed to go up when the DXY is heading down. The Kiwi is supposed to be heading to the upside, but the Kiwi was not heading to the upside. Instead, it kept on coming down and down and down and down and down. And that is the situation we had in our hands. So one thing I will tell you is that there will always be situations like this. So where is all of this coming from? All of this is coming from Japan. We have a situation in Japan where Japanese do not pay any type of interest at all. The interest rates in Japan are zero. And now keeping the interest rates in Japan at zero simply means the Japanese currency is going to be absolutely weak, making it very cheap and easy for foreigners to travel into Japan and spend their money. And of course, making it very easy for the Japanese companies and, of course, individuals to borrow money to spend and equally grow their economy and expand operations and all of these things in order to compete. And then what that also does is that it opens up doors for foreign investors to actually come into Japan, borrow money, and head over to a place like Australia where interest rate is 4.3%. We come to Europe is around 4.25. In the US is 5.5. Don't know how much it is in New Zealand. But what happens is that when investors take these loans in Japan, because it's interest free, they can go to all those places and use it to buy government debt. And when they buy this debt, they profit on the margin. So you basically call that carry trade. So you're taking loans from here and then using it to invest in a currency that it has a higher yield than the other one. So that's basically how it works. But then Japan decided that they were going to add some rates. They were going to, raise the interest rates. I think they raised it by 25 basis points, that's 0.25, and indicated that they were going to raise it further. And guess what happened? That meant the Japanese strength gained tremendous strength overnight. Immediately, that sent shock waves to the market because there's always an inverse relationship between the currency and the stock market. It's always inverse. When one is going up, the other one is going down. So that meant the Japanese index, the Nikkei index 225, it went straight down. And because the entire global financial system is interconnected, that sent shock waves to Europe, it sent it to China, it sent it to Hong Kong, it sent it to the entire US stock market is down. You head over to Germany, it's down. You head over to London, it's taking a beating. And this is exactly the current situation we have in our hands. Now, as traders, and then let's not even talk about it went over to the crypto market and it murdered crypto. So what now that now did, of course, it went over to the crypto market and it sent it down as well. So now what that simply means is that it now meant that we are going to start anticipating that the Federal Reserve are going to actually cut interest rates and all of those things. But I want you to understand something. As retail traders, it doesn't matter how you look at the market, whether you look at fair value gaps, institutional, this, that, XYZ, we are all retail traders. We are retail. We are retail traders. We're not institutional traders. And what makes us retail is that we do not have access to the institutional information. Let's say, for instance, they call an emergency Federal Reserve meeting to cut interest rates, and they decide that they're going to cut rates. There are institutions and people that will know about those things. There are people that are going to have that information. And guess what it's called? Sometimes it's called a black edge. There are people who are aware of certain things. That's why you start to hear of things like insider trading. So, for instance, when Warren Buffett purchased 5 million shares, I think of JP Morgan, and then some guys at JP Morgan head of it, and it had not been announced. They gave the tip to some hedge fund manager, and then hedge fund manager went and bought Goldman Sachs shares, JP Morgan shares. And when it was announced, the shares went up, all of these kind of things. So that's insider trading. We do not come close to having the type of institutions of information that institutions have. And that is exactly why we are retail. We do not have access to their tools. We do not have access to the information they have. We do not have access to a whole lot of things. I want to quickly point out something. On the 24th of August, we have an event coming up. We're supposed to hold that event. It's a physical event. It's a live event. And for those of you who are not in Nigeria, we also have an online version coming up on the same day. Have a webinar as well. Of course, this event is targeted at all Tickmill IBs and is targeted to all traders as well. Because we are going to be discussing about how you can build your business as an IB. And most importantly, we are going to be looking at the global financial markets. We're going to be looking at how money is created, the printing of money, the supply of money, inflation, global inflation, macroeconomics. We are going to be looking at a whole lot of things in great depth on that day. The reason we are going to look at this is because there is when your people are learning how to trade, people just learn technical analysis and all of these things and you feel it's enough. When things go wrong, for instance, like type of situation you have in the market, do you have enough information in your arsenal to be able to address those kind of situation. What do you know? How much do you know about the markets? Do you know, can you interpret financial data? Can you interpret economic data? How much can you interpret? How much do you know? So these are the things that we're going to be looking at in great depth. And of course, all of these are going to be coming together to actually shape a profitable trader. So please make sure that on that day you attend the event. Of course, the link to that event is going to be somewhere in the comments, because this video is coming on YouTube. The link to that event is going to be somewhere in the comments. So please make sure that you do not miss it for anything or anyone. All right. And of course, with that being said, I really like to invite you to subscribe to the channel. There's a ton of educational content in here in the channel that you can go through. So please don't miss it at all. And one more thing I'd like to tell you is that if you are a trader that has been affected by what just happened in the market, please do not take it personal. Your strategy has not stopped working. Nothing is wrong with your strategy. Nothing is wrong with your system. It is just time. The market is just saying maybe it's time for you to take a break. And of course, hopefully the Feds are going to intervene soon. And of course, we are going to have the markets, rolling off, and of course, things getting back to normal. So please, ladies and gentlemen, I really wish you good luck and good trading going into the coming season, and stay safe out there. Cheers.